How a business owner can save 10 million plus in taxes. Hey everyone, Adam Bergman, tax attorney and founder of IRA Financial. Now on today's Adam Talks, moving a little bit outside the IRA and 401k world, just for this episode. Just thought this was a fun topic. Actually had an interesting discussion with a fellow tax attorney and accountant over some drinks recently, and this qualified small business stock concept came up, and I was like, you know what? I think I've talked about this several years ago, but this is a really important topic, especially now that the corporate tax rate is still at 21%. This is a super valuable, potentially huge tax saving structuring concept that a lot of entrepreneurs just have no idea about. And by the time they've ran their business and they're ready to sell and they're in an S Corp or an LLC, they're not eligible for this QSBS $50 million value and up 10 million plus exclusion. Yeah, I'll go through it. It's remarkable that Section 1202 of the tax code does not get more play. You can literally save 10 million plus in taxes. Yeah, I said it. I'll say it again. 10 million, not dollars, 10 million plus dollars in taxes. So 1202 was enacted all the way back in 1993, not a new provision. But the fact that since 2017, corporate tax rate's been just 21%, there's a lot stronger incentive to have a C Corp today than there was 10 years ago, which the corporate tax rate was at maximum 35%. So essentially what 1202 does, and I'll break it down, is basically says, if you have a company, a US company, a C Corp, not an S Corp or an LC, US C Corp, you own the stock, okay? The company's worth less than $50 million, okay? It's less than $50 million in asset value, and it's operational, and it is deemed a qualified business, which I'll help define what that is in a moment. You could exclude up to $10 million from the sale from taxes, and plus 10 times of what you invested. So if you invested a million, you could also exclude another 10 million. Okay, so that's why you can go plus the 10 million. So again, it's got to be a U.S. business, C Corp, active, qualified, and the assets got to be $50 million or less. Okay, and you can do it. So what's a qualified trader business? It's basically any business that's not involved in the performance of services like health, law, engineering, architecture, accounting, actuarial services, performing arts, consulting, athletics, financial services, brokerage services, or any trader business where the principal asset of a trader business is a reputation or skill of one or more of its employees. Banking, insurance, financing, leasing, investing, farming businesses, also hotels, motels, restaurants, or similar businesses. So in other words, it's basically companies involved in tech, retail, wholesale, manufacturing, generally will satisfy the qualified small business sector. Now, they also have to be an active business, right? So let's just break down again what are the requirements, because I just want to make it super clear. You need to have a 409A valuation of $50 million or less. You got to have stock. It's got to be a U.S. Corp. Stock options, warrants, and convertible assets are not good. They don't qualify. You got to hold the stock for at least 5 years. So this is important. It's a 5-year holding period. So if you start a business today, put in $1 million, and someone buys it tomorrow for 100 million, you don't get the exemption. You got to hold it 5 years. You got to hold the stock. Okay, it's got to be active, and it's got to satisfy a qualified trader business, which again, essentially anything other than like a law firm, healthcare, banking, insurance, financing, leasing, investing, farming, hotel, motel, restaurant, essentially financial, technology, retail, wholesale, manufacturing sector. So it doesn't apply to everyone, but applies to a whole huge segment. But again, LLCs don't work. S Corps don't work. Partnerships don't work. It must be a C corporation, and you must own the stock, and you must own it for at least 5 years, okay, before you have this transaction. Okay, so now let's talk about the $10 million exclusion. So you basically, under 1202, you can limit the amount of gains that can be excluded for any taxpayer, and essentially in a given year, 1202 provides that every taxpayer enjoys a minimum $10 million exclusion for the gain triggered by the sale of a corporate stock. So if you sell the company for 10 million, it all should be excluded. Now you can also have a gain exclusion that exceeds the 10 million if you put some money in. And that's called the 10 times rule. Under the 10x rule, essentially you get 10 times the amount of cash or value you contributed to the company in exchange for the QSBS. Now the stock needs to come from the company. You can't buy it from someone else. It has to be issued from the company, corp, US trade or business, 5-year rule. And if you put money in, you get 10 million plus 10 times the amount of cash or property you put in. So here's an example. Let's say you purchased qualified small business stock for $5 million, 7 years ago, and you sold it for $70 million. You would get the $70 million, meaning $10 million exclusion, and then you'd also get 10 times the 5 or another 50. So essentially you would pay, you have the exclusion of 50 plus the 10, so you'd only pay tax on so you get the 10 and you get the 10 times the 5, which is 50, giving you 60 protected. And so you have the 60 out of the 70, so you're only paying 10 million. There's only a 10 million net there that you have to worry about. So you get the 10 million and you get the 10 times the 5, which is another 50. 50 plus 10 is 60. So essentially you're going to get pretty much most of your $70 million, right? Because you have a $5 million basis. So you get the basis of 5. So out of the 70 million, that's $65 million of potential profit. You get a 10 million exclusion plus another 10 times 5 or 50. So out of the 65, 60 is excluded. So you're only paying tax on 5. So imagine you sell your company for $70 million, you only pay tax on $5 million. It's about 23% tax on 5 million instead of 23% tax on 65 million. So it's monster opportunity, right? And that's why I wanted to go through this example. The idea is you can sell a business worth under $50 million. Even if you sell it for 50, in this example, everything would be excluded, right? Because you get the 10 million and then you get 10 times of what you put in, up to 50 million. So of value. So it's just an incredible option. So a lot of folks are like, nah, I never want to set up a C Corp. I'm going the LLC way, S Corp, C Corp, forget about it, 21% tax. No one sets up C Corps anymore. Could be wrong. If you, again, are in technology, retail, wholesale, manufacturing, and you are able to buy stock from the company, hold it 5 years, US business, it's qualified, it's active, you own the stock, value under $50 million, and you sell it, 10 million exclusion plus 10 times the amount you invested could shelter the gains from tax. So again, this is a massive tax strategy that not enough entrepreneurs know about it. Now I get it. You're starting a business. You're not really focused 100% on selling your company for $100 million. You're more focused on, getting off the ground, getting funding, finding an office, getting some employees, getting a website going, whatever it is. That's where your focus is. But in the back of your head, you may also want to consider that, hey, if this thing takes off, having that corporation, holding it 5 years, making sure, obviously, you're part of the qualified small business definition, right? If you're doing a service business or a hotel, it's not going to work. So the C Corp's probably not the good option. But financial business, retail, manufacturing, wholesale, satisfy that definition. You should consider the C Corp. You definitely want to talk it over with your tax advisor, CPA, or tax lawyer. Plan, structure. You're going to hold it 5 years. Most businesses get sold after 5 years. It's hard to build something up faster than 5 years. That's possible, but it's tough. So it's generally stock that's issued by the company, not that you paid something for it. It's not options, not warrants. It's a U.S. company, U.S. C Corp, stock you got to own, active, qualified, hold 5 years, value under 50 million. You can exclude 10 million plus 10 times the amount you invested. Pretty good, right? So that's today's podcast. That is the purpose of today's podcast / video, is to just remind you that if you are starting a business, or maybe you have a corp, maybe you want to get that valuation. Make sure if you're going to sell it 3 or 4 years, maybe you want to hold it an extra year. get that 5 year, and then you can exclude all the gains from tax. It's really a remarkable exclusion, and it's really amazing that it's still in there, right? You would think some of the progressive Dems may push that 50 million number down to 5 million, but they've kept it. It's been in the code since '93. There hasn't been a lot of chatter or debate about maintaining it or not, right? Like it's certainly gonna help entrepreneurs. Now, if you're selling your business for up to 50 million and you're going to exclude up to 10 million, now obviously it could work if your business is 1 million or 10 million, but you would think that some of these progressives would have just wanted to cap it at maybe 2 million or 5 million, but they haven't yet. So the opportunity is still valid. C corps are not as tax harmful as they were pre 2017 with a 21% tax rate. So again, it's just something to consider, just some food for thought. If you are starting a business, thinking of starting a business, have a C corp, looking at selling your business, 5-year rule, make sure you're in the qualified sweet spot, and get a valuation of less than 50 million, and bank, you could potentially save 10 million plus in taxes. So thank you for hanging out with me today. Hope you guys enjoyed today's podcast. If you're watching on YouTube, thumbs up, really appreciate it. Don't forget to subscribe. Otherwise, enjoy the rest of your day, and I'll see everyone again next week. Ciao, and be well.